The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. I want to start out by reporting a little news item that someone sent me over the evening, and I think it's quite interesting. It's a picture of Remus Reed. He's the great-great-uncle of Harry Reid, the state senator. He lived in Montana during the 1880s, and it's a picture of him standing at the gallows. The back of the picture, it reads, Remus Reed, horse thief, sent to Montana Territorial Prison, 1885, escaped 1887, robbed a Montana flyer 6 times, caught by the Pinkerton detectives, convicted and hanged in 1889. Well, I want to show you how politics works. The response that came from Harry Reid's office was this. Remus Reed was a famous cowboy in the Montana Territory. His business empire grew to include acquisition of valuable equestrian assets and intimate dealings with the Montana Railroad. Beginning in 1883, he devoted several years of his life to government service, finally taking leave to resume his dealings with the railroad. In 1887, he was a key player in a vital investigation run by the renowned Pinkerton Detective Agency. In 1889, Remus passed away during an important civic function held in his honor when the platform upon which he was standing collapsed. And folks, that's how you spin politics. So anyway, this is what we have to live with as we go through all this stuff. But I'm going to go from, by the way, if you go back to our history and look at anything on genealogy and looking at your ancestries, we all have people in our past that have done things that, we probably should have just because of the times they were forced to do. I wasn't making fun of Mr. Reed or anything. It was just the way that they responded. And the response was correct. They didn't lie anything in there. That was all true. It's just the way that they spin it. And we see this all the time in politics, and we see it in the markets. And we see it especially in the markets because everybody, is really consumed with the concept of making money. What I'd like to do now is I want to work on the Bradley model this morning a little bit to tell the folks a little bit more about it. Basically, the Bradley model, it was done by Donald Bradley in 1946. He was not a stock trader or anything. He was a pure astrologer, and he wrote a little booklet that cost $4. And he only used 1 year for 1946, and he published the book in 1947, and it had a very high correlation to what the stock market did. The book, stayed pretty much dormant. Nobody did anything with it until 1985 when Dr. Miller, showed me how to do it, and then I started to research it, and we went back from 1876 to 2000. We're still doing it, 2013, so that's 46 years. And we know that there's a high correlation. What I've done into Tiger TV is I posted the E-mini S&P showing the big butterfly pattern that's forming now, and then there's a white line there that is the inverted Bradley model. And then within that model, I've marked 4 yellow areas where there were major trends in the Bradley model because it's related to date and to trend. Its best examination is if you look at it for the trading dates themselves, and then that's what we have now. We're over a very key trading date right now here in the S&P. I would like to mention what also Basil mentioned and also Steve Rhodes mentioned, that if we get above this 1518 in the S&P, we can easily go to 1545 because that would complete a very large move from June through November. And we could make that. The markets, there's a lot of divergence here. Doesn't seem like it's going to do that, but there's always a possibility, that is, in the cards that they could be doing that. Now, another thing to look at on this chart, if you get a chance, is the move that we made from November when we had that solar eclipse and new moon, and to where we are now was basically straight up. and completed a perfect AB equals CD. And now what we're doing is waiting to see if this market is going to top at this particular spot. Now, I've marked the three highs, the one in March, and then the one in September, and then the one also that we're having right now. And you'll notice it's not unusual for the market to have the wild volatility like we had over the last day or so, where the market was down 150 and then back up 150. That's not unusual at all at these tops. Because the bullish consensus is as high as it gets, and there is no fear in the market, as shown by the VIX index, and that's what we're looking at as far as whether these markets are going to stop at these levels. And we don't know, but we're just looking at the patterns. The patterns are telling us that we're very, very close to what we think is a very significant top. And if it is correct, we're going to be down for several months. The patterns are there. All the things that we look at seem to be, lined up. The S&P cash has gone up and made that 1.618 expansion. It has not taken out the highs of the fourth yet. They probably, or they might soon, but they haven't done that as yet. So this is what we're looking at as far as the cycle work that it's doing, and it could fail. And if it does, the market gets above this 15, 16, 15, 18, that would tell us we're probably going to go to that 1545 level. If we look at, and we will look at some of these markets around the world, the emerging markets, and get an idea of where they're going to be, in the next few days or weeks as we go through the show here, because we'll be able to see, how their patterns look and what they're doing, because they're doing something, absolutely, totally different. Someone asked me a question right before the show started about my view on Apple. We had that big, 15-point move yesterday in the Apple, and, that really doesn't mean anything. Apple's got to get above probably $500 a share in order to change the trend. It still looks like we can have a move down to that 394. I see no reason yet that tells me that we're going to, have anything different than that. We've also kept an eye on Google. We've also kept an eye on Amazon. All those patterns are completing. They're acting like they want to, to head in the right direction, which we think is down. So those are, three of the biggest stocks in the NASDAQ, and the NASDAQ has been, by far lagging the market, by a great deal. So those are the main things that we're looking at in the market, for today, at least, from the Bradley point of view. And the Bradley model is a guideline, folks. That's all it is. There's only about 4 times a year where it has these major turns, and those are the ones that, are very, very important. The trend of the market can also follow perfectly. I would give a scale of about 6 on the Bradley model now, but the trading dates on the Bradley are still very powerful, and that's very powerful. That's why we were looking at that November, 15th date when we had the solar eclipse and the new moon. That was a very strong Bradley date that happened, and then we had one right after Christmas Eve that was also relatively important. But the one we have now is very, very big because it encompasses just a huge number of different cycles that are there, and they're all cycles. That's all there is. There's nothing, there's nothing mundane about the astrology part. In other words, it's not being, contrived by the zodiac of Aries and Capricorn and the houses and stuff. It has nothing to do with that. It has to do with just the actual movement of these different planetary pairs and how they're weighted. That's all it is. It's just a cycle phenomenon, and nothing more, nothing less. Now, what I'd like to do now is I would like to go and give you an idea of the Chinese market, because it's looking certainly a lot different than the market that we have. It's had its top, a lot earlier than what we've had here. And, everybody, again, is talking about China is going to be the one that, pulls us out of this. Well, we completed the big ABCD pattern, in the Chinese market back in early January, and we've already taken out the lows of January, as of yesterday. Well, actually, it's actually today. So those markets are a little weaker. So we see a lot of discrepancy, in some of these things around the world. And if we go and if we look at the emerging markets, which are, a combination of, the South American and some of the Asian markets together, I don't know exactly how this how this ETF comes together, but you'll see the same type of scenario that you're dealing with here is because you're looking at a market that's already taken out the January lows, and it's certainly in a downtrend. This might change, but why didn't it go up and make new highs? With the rest of the markets, you have to ask yourself the question. Why is it that it's not performing like the rest of the markets? And I'm just looking at divergences because I think that's the key, to what we're looking at here is the divergences of the different markets that we're actually looking at. Now, part of and I will cover this at the break, but there's so much stuff going on in the currency markets with the Japanese yen and the euro and the British pound and stuff. After we come back from the break, I want to cover some more of that to make sure that we can cover, what's going to happen, in these markets, because they're having tremendous volatility in the currency markets, and a lot of it is related, to this Japanese yen U.S. dollar trade, which had been the carry trade, and that was, where they actually moved the market up because they would borrow money from Japan at zero interest rates and invest it in gold and other things, and they did this for years and years, and now that is changing a little bit, so that's unwinding, and that used to be, 30 years ago, the yen was 260, to the dollar. That's when Japanese was, the number 2 country in the world. They were getting ready to, surpass us. At one time, 30 years ago, they showed a special on CBS. I remember this very clearly. As the reporter put a $1,000 bill down on the streets of Tokyo, and the $1,000 bill is just a little bit larger than a U.S. dollar bill, and he said, "This is how much money $1,000 will buy real estate in Japan." It was just a few square inches, and of course that was the top of the market, and things collapsed from there, and they've been in a bear market for 30 years. They finally had another good rally recently, but that's really. We've got to take a little break here. 877-924-6678. Thank you very much.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks, and we're taking a look at the Treasury bond market right now. This is one of the markets that is probably it's much more fun to trade than the E-mini S&P. It ranks up there with the foreign currency markets for trading and also gold and crude oil. But what I wanted to do is to go down and show you the pattern that we have happening right now in the overall market over the last 6 or 7 days, just by looking at the hourly chart. And it basically shows how it makes 786 retracements and 61% retracements. And it follows the patterns that we look at, the ABCD patterns quite nicely. It's very, very liquid to trade because it's, far, far larger in volume than the stock market. This is a 30-year bond that we're trading, also known as the ZB. 1 point in the ZB actually 1 tick is worth 31.25. So there's 33 ticks in a point. So if it moves a point in 1 day, it's $1,000. And we basically had almost $1,000 move from the 61% retracement up to the 786 retracement today. And now we've had our first little pullback that's come in, just recently. Now, those of you that trade the E-mini, there's a real interesting phenomenon that occurs, is that when bonds are usually topping or bottoming, the exact opposite is happening in stocks. I know it's a short-term phenomenon, but it works, for looking at trading, various things for intraday purposes. In other words, if you're in the E-mini S&P and you're watching the bond market, and the bond market is, completing a big pattern, you want to be really careful, about the S&P, because that's the situation where, the market will reverse because money starts to move, out of stocks and into bonds and vice versa. It's a short-term phenomenon, but it does work. Sometimes it works for weeks and weeks on end, and then other times it'll fade away, just like other cycles. And, none of them are perfect. This is all about probability, and it's all about risk control. It's, those are the two things that you have working for you, is the probability of being more successful than losing. And the second thing is, and the most important thing is, that you can control your risk. Because if you can control your risk, then you've really got a chance. Trading is a lot like golf or just about any other sporting event. If you're out there on a golf course and you bogey the first 3 holes, you don't throw your clubs in the lake. You just keep going, and hopefully you'll improve. And that's how you do it. And if you hit 200,000 golf balls, then you're able to play, around the golf with Tiger Woods. And that's, one of the, I guess it's Roy McIlroy now. I guess he's the new king of the hill. But it's all about, dedication and persistence and sticking with it. And I'll take someone asked me how long it takes to be a good trader. Well, first of all, you have to define what a good trader is. And I would say someone that, exercises his rules, as he sees them and stays disciplined to that, then you've got to be able to, use that as part of, what it takes to be a good trader. Try to be consistent and make a little money every day is a good thing, because, you have to make a living at this in order to, to show that you do have the capability of being able to do this. So that's the, the best analogy of, being successful in trading. But some people are, far more successful than others. Now, we've only got a few more minutes here before we go to the next break, and I wanted to go back to the bond market for a little bit and just take a look at the muni bond market, because we've had some really big things happening in the bond market. The muni bond market has just completed, back on about a week or so ago, it just completed a bearish Gartley at the 61% retracement. It had made a double top from that February to December high to low. And so this is telling us that the muni bond market is most probably getting ready to, be, heading towards the downside. But we'll have to, wait and see. All I can say is about the bonds, if we close below 142 in those Treasury bonds, that's going to break, especially if we rally just a few days. We've only been rallying 3 days now since the 4th. Since the 2nd. It's the 28th. I forget what month we're in now. But that is true. We'll see if that is going to be the case. If we go below 142, then there's going to be some really think. Someone asked the question, is it true whether junk bonds will lead the market down? I'm not sure, but we'll talk about that when we get back from the break. The number is 877-927-6648.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91. And only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and we're going to talk about the gold market because we have a really interesting pattern that is, completing now in gold, and we follow it, all the time on this show. And basically, I'm going to put in the long-term daily chart that shows the, the beautiful symmetry that's been there since October. And what we've done now is we formed a pennant in gold with, higher bottoms and lower tops, and we're going to have to come out of here very soon. We've got about another week, and then gold is going to have to make up its mind whether it's going to go higher. The fact that it held the 61% retracement down here at the level of 16.27 per ounce is very good. We had a pretty good rally of better than $70 an ounce, and then since that time we've had several instances where the market has backed off and held. I think the best way to describe what's happening in the gold market is to go down to a smaller time frame, and you'll see the really nice harmony that is here in the gold market, because it's one of the better markets to trade. It has terrific liquidity and everything, and the stops are filled where they're supposed to be. Your orders are filled really well, and so that makes it really interesting. But since the 24th of around the 24th of January, this market has had 4 higher bottoms, and they've all stopped at either exactly 61% retracements or 786 retracements. Each one of them was, right on the money. And then last night we had a bearish Gartley form on the 30-minute up at the 1680 level. We backed off, just about $4 from there. But the real key number that we're looking at here is 1690. If we can get the gold above that 1690 level and get it there with gusto, actually if it got above 1700, that's only $24 away from here, and it certainly could. So that's what we're looking at from the gold market. I've been bullish for gold for a long time. I remain bullish. I've been buying these dips that occur because they're so beautifully harmonic and everything. It's really hard not to take a nibble at them the way they've been acting. And actually silver has actually been holding up very well also. The problem that I see is that when I look at the open interest, there's just no interest in the silver market. The liquidity is drying up quite a bit. If we could get a lot of players coming in, either from the long side or the short side, it wouldn't make any difference. At least we would see more, liquidity coming into silver. Gold is okay, but silver still lacks, a great deal of liquidity. Now, there's a lot of ways you can look at this, this gold market from a long-term perspective, but one of the things that we need to do, because we try to watch divergences the best we can, and that is to look at the gold silver index, because we've had a great deal of weakness in this market, and if you want an excuse to sell gold, you don't need to go very far other than to look at the gold and silver index, on the daily basis, because, we have had some patterns held up at the 61% retracement and had a nice 5% rally, and then we went down and went below the 786 retracement, and we're still below the 786 retracement, which is not a bullish sign, yet gold is holding up extremely well. Why the gold stocks are so weak is, really an enigma to me, because we have, tremendous buying on just about any stocks have been going up, and with the exception of Apple and some gold stocks. But you have to ask yourself, if the metal is really that bullish, why aren't the gold and silver stocks, that are actually doing the mining on this, why aren't they going up? Now, I always hear the argument that, that there's the cost of getting the gold out and stuff. Folks, that doesn't mean anything to me. I'm just looking at the prices. If there's more buying, prices are going to go up. If there's more selling, prices are going down. That's basically, what I'm looking at. Now, the one stock that I keep an eye on, which is the largest of the gold producers, which is Newmont Mining, and we've watched this stock for a long time, and it's had some really nice patterns along the way. And you could almost teach a course in technical analysis in the Newmont Mining stock, because when it bottomed in July and had the huge run-up, all of the retracements, there were 3 of them, were exactly 38.2%. And the market topped at the 1.618 expansion of the June to July move, and then we started down and we went back below those lows. We've tested them 3 times now, and for the first time in a long time, Newmont is beginning to act, relatively well compared to all the other stocks. It's been up about 5 or 6, days in a row. So as long as it stays above that 42 level, it looks like it has a chance, to do okay. So that's all it is a chance, because you don't know for sure, whether the market is going to go up or not. You never know that. It can go up, it can go down, it can do anything it wants, of course. But just remember that you have to protect yourself, on the downside, and that's the real key when you're trading, is to do those things, and that will keep you in the game for forever, because that's what you have to do. Always think about how much money you can lose. Don't worry about how much money you can win. Think about how much money you can lose, and you'll be far better off than if you do it the other way around, without any question about it, in my opinion. Now, I would like to go and talk about the dollar index here, because we've been watching this for a great deal of time here, and it'll just take me a second because I can't move my mouse fast enough to get it to work. There we go. And this shows a very interesting technical picture that we've we've talked about several times on all the shows that I do because the dollar is so important. If you'll notice, that level of 79 that we talked about last week we went down and we touched that level. It basically took out the December lows. There was an ABCD right at that level, completing a little butterfly pattern. It was also at the 786. And if you'll notice on this that we have some rising bottoms lines. In other words, the bottoms are higher. We have lower tops too, but that's the same type of pennant formation that we're seeing, in the gold market. So a lot of these are hooked together in that point. The one thing I do know for sure is that if we close below 79 in that dollar index, that would put the euro up in their 139 level, I would guess. Then I would think that there's going to be a currency valuation and devaluation, and we'll see what happens. Okay, we've got a call from our friend in Philadelphia. John, are you there?
Hey, Larry. Good morning to you.
Good morning to you, my friend. How are you?
Good, thanks. Larry, you sparked a question for me when you spoke about gold and Newmont mining. The question had to do with a caller into your show, and I will just go from memory on this, but back at Labor Day in 2011, just as gold was making its peak at 1920 or so, and the gold stock index, whether you're talking the XAU or the HUI index, those also were making peaks. And a fellow, I recall this vividly. In fact, I made personal notes on this. A fellow called into your show and identified himself as a fellow named Tim from Oregon. And at that time, he spoke to you, and I couldn't help but think this was a friend, a former associate, somebody you knew well, because he spoke to you with a great deal of familiarity. Anyway, back at that call, he shared two things. One, a beautiful ABCD topping in the HUI September of 2011, and he also showed a fabulous Fibonacci relationship to a peak in time for the gold price connected to the 1980 top. Anyway, that turned out to be the top. He seemed fairly convinced tops were occurring there. The reason for my sharing this is to then just say, is this a personal friend of yours, and have you spoken to him, and does he have anything to say worth merit in gold or gold stocks here and now?
No, I haven't spoken to him for a while. He was a student, and he's an active trader, but I don't talk to him that often. I receive charts from him less than I receive charts from you. And John, I really appreciate the stuff that you send me because it's really first quality. Your lumber move was spectacular, and so was your cattle move. But as far as Tim's concerned, he really is. He likes to be a recluse. He lives outside of Vancouver, British Columbia, is where he lives,
sure.
And he likes to. He primarily trades gold and crude oil, but he does a lot of technical work, as you know. But he doesn't know anything about fundamentals like most of us anyway. But he does do a lot of work with Fibonacci and cycles and stuff. But I don't hear from him that often. And when I do, I certainly pay attention to it, just like I do when you send me one of your charts.
Gotcha. Well, I couldn't help remarking. I recall when he did call in, and he showed two just phenomenally interesting.
Mm-hmm.
One was time for the gold price, and the second was the price level for the HUI.
Mm-hmm.
And it turned out, of course, those were major highs for both, and it was just spectacular the work the fellow did, and I'm real curious if he has got any other brainstorming ideas lurking in there somewhere. So anyway, listen, thanks.
Hey, I have a question for you, my friend. Do you have a minute?
Sure thing.
Okay, I come into TFNN for a couple hours usually every day, just to see what's going on and the questions that are being asked and stuff. I watched your trades because you post your trades as they're happening, and I know you do that for a lot of different reasons that we've already discussed. But do you get much feedback from the folks that are in the Tiger Den, that the accuracy that you have? Because I watch them, and you really do a spectacular job, and even on your losses, they're very, very small. So, and I know you are successful, but I was just wondering, do you get much feedback from the people or not?
Yes, and the answer to that question, and only privately, I encourage everybody who's listening and in the den to participate openly and widely. Better for everybody. Flesh out lots of interesting ideas that way.
No, that's great. And, you know, I'm a big proponent of TFNN, not just because I do the radio show, but I like Tom and everybody that's on the show. And Basil's having a free webinar, and anytime you can get a webinar with Basil, whether you have to pay for it or not, is certainly worth it. So they have some great educational things here, but the things that you post in the den are really spot on. I know a lot of them are a little off the regular path of some of these folks, but the patterns and the things that you look at, you know, are certainly there, and you do a great job.
Larry, I'll tell you, I've found great utility in applying your techniques, and I can't stress enough how valuable I found reading that text of yours, Trade What You See.
Oh, thank you.
It's amazing how often, if you do enough work, that the tradable patterns that you presented there come up, and frankly, I had worked for probably 25 years until I met you, and several of those patterns and techniques I'd never seen anywhere else. And I thought I'd pretty much seen it all, but of course, we're always learning new things. Well,
we all learn from each other, and we certainly appreciate your contribution today. Thanks a lot for calling in, John.
Thanks. By the way, Larry, if Kim gets in touch with you let us know, please.
I certainly will. I'm having a hard time getting in touch with Bill Foster. For some reason, he's incognito or something, because I haven't been able to reach him. I want to get him back on the air, because, you know, he talked about the $1 million trade of, you know, being short stock index futures and short the bonds, and I'd like to get him back on just to see what his angle is going to be on that.
Thanks for the time, Larry.
Yeah, thanks for calling in, John. I certainly appreciate it. Okay, folks, now what we're going to do now is we're going to stretch over to Japan, and we're going to take a look at the Japanese yen. And we will be looking at it on a weekly basis here, because it's had a move of tremendous proportions. I think it's been up just about 20 weeks in a row. We're approaching the 786 level of 95.70. And if you remember, when the market was down around that 75 level, Tom O'Brien and myself and a few other people, Steve Rhodes, were really interested in that. And I think this is the big surprise in the Forex market for the year. I've been saying that for a long time, and it's certainly been a big surprise, and it's moved up quite a bit. Now, the frustrating part for me is that, I was very bullish, and we'll get on to this in a second. We've got to take a break to take pay a few bills here, 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we're going to end the show talking about we'll finish up with the Japanese yen. There's a chance that the yen has made a pretty significant top here over the last 3 or 4 days because we made a 3-drive pattern up here at this 94 level, and then we retested it one more time, and now we've come down to the 786 of the previous swing. And if we can get below the 93 level, that means we could start our first correction. And believe me, we will get a good correction in this. The market is so overbought. You realize we've been up, I believe, 20 weeks in a row, and you go back on any chart and find out how many times that happens, and you'll see that it's not very often. And we'll see if that's going to be something to look at. But that's what we'll look at, down the road a little bit. Now, we had a major thing happen. I know it's a commodity, but it's important to all of us, and that is crude oil. And we had a major, Gartley pattern form here on the dailies, and I will put that into the Tiger TV. It came in at the 786 level, and it looks like, it's held so far. And that level is very, very important because it's also the same 618 level from the high from last March into June. It went back and retested that same level one more time, and it's backed off, several dollars a barrel so far. That's not very much, but at least it's a start. The direction that it's supposed to be, moving. That's the way we try to look at it. That's an important commodity because it's like a tax on us. If it goes up, we can't use the money for anything else. Now, there's one other currency that is under great pressure right now, and it looks like it wants to go a great deal lower, and I will put that in there to give you an idea. It is the British pound. I'm laughing because somebody in the Tiger's Den beat me to it, says it's going to be the pound. And so it's interesting that, it is the pound. We've had a triple top in the pound, way back at the 163 level. We've been talking about that for a very long time. But the important thing now is that we finished a big ABCD move to the downside, and then we had stopped exactly at the 618 6 or 7 days ago, and we had a very strong rally for 4 days. And then the market has now broken down and come down below the below the 61% retracement. It's trading just about there now, but it has broken below that level. So if we happen to close below 156 in the British pound, that would certainly validate this pattern as being failed, and we would be looking at another few points down to the downside. So a lot of things happening in the currency markets. Most of it is related to the Japanese market because that's the one that has kept the dollar above these levels. In other words, being long the dollar, short the pound, short the yen, and that's kept the U.S. dollar above that 79 level. And that's a very, very important level. Live every day in an attitude of gratitude, my friends, and may God bless and help the needy. They need it more than you do.